Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings and welcome, Jay. It's fantastic to have you on the podcast show. It's been a while now.
Yes, Bob. Nice to see you as well. And it has been a while. And, markets are markets though, right? So plenty to talk about.
Absolutely. And, before we start our conversation, I did want to do a time check, because we're doing this on Tuesday, the 17th of September, which is before the Fed meeting. So we may talk about the Fed. And by the time you listen to this podcast, listeners, the Fed will have done their meeting. But we'll talk more medium term in any case. But the first thing I wanted to talk about was this whole focus on the recession risks. We've had a couple of flare-ups over the course of this year, and there's been some dynamics between equities and economic data, where bad economic data now is leading to weak equities, which isn't often the case. Sometimes bad news is good news and so on. But it seems like markets and a lot of market participants are worried about a recession. The labor market is one indicator they've been looking at. So what with your sort of experienced take, what's your view on this?
Yeah, we would just say that some investors, and certainly a fair number of prognosticators and commentators have been talking about a recession for several years, not just several months. And we've resisted that temptation to join them for the same amount of time. So we've been constructive, really almost consistently from the COVID low in March of 2020, and certainly over the last 18 months or so. I mean, we wrote our 2024 outlook back in the fall of 2023, and we titled it "Surprise, Surprise." And we talked about four global macro surprises that we expected to unfold, and nowhere in there was recession. And so we'll get into what the four surprises were, and they're playing out quite nicely. But, we've not been a believer in recession. And in fact, our latest monthly, which we just published on Friday, was titled Rotation, Not Recession. And when we look at the world, we see a global economy that is growing kind of in line with expectations. In fact, Oxford Economics just came out and highlighted the fact that for the last 7 quarters, global growth has been between 0.5 and 0.7% quarter over quarter. So very stable. And we see, more importantly, we see no major imbalances that need to be fixed. And this is really critical for investors because we're about to embark on a Fed rate cutting cycle. The world is already in a global rate cutting cycle. The Fed is late to the party. We think this rate cutting cycle will be one of the most synchronized in the last 40 years. And JP Morgan is the one who first came up with that stat. And we think it makes sense. But really for investors, and this is, I think, kind of important to remember in today's, media saturated world, it's not whether the Fed cuts 25 or 50. That, in my view, is completely meaningless. The point is that the Fed is shifting from rate hikes to a rate cutting cycle. And the history is very clear. When the Fed cuts and there's no recession, stocks are up meaningfully in the next 12 months, 15 to 20%. Goldman just put out a nice report on this in the last couple of days. When the Fed cuts and there is a recession, stocks are down 15% or more over the next 12 months, stocks being U.S. equities. And so that's really the question. And as I said, we see no signs, certainly in the U.S. nor globally, of a recession. The labor market is in fine fettle. Sure, its job growth is slowing slightly, but we're still at near record low unemployments in the developed economies. We have a global rate cutting cycle we just spoke of. We have no real inflation concerns to speak of. If you look at inflation break-evens, they're at lows since COVID in the United States. And so we don't really see corporates are in fine shape, borrowing with no problem. Credit markets are not signaling any recession. That's very important. Typically, credit markets are the first tell for recession. Credit markets are completely fine. And the consumer is completely fine, as we saw just yet again with the retail sales numbers out of the U.S. this morning. And so, consumers have lots of money. The numbers in the U.S. are just astounding in terms of the growth in net wealth, household net wealth, between rising house price appreciation and stock price appreciation. The numbers are in the trillions. And then if you look at, household debt to income or any of those disposable income, any of those statistics, it's as benign as it's been in decades. And so the idea that the consumer is about to fall out of bed, the idea that companies are all of a sudden going to start chopping employment, the idea that there's going to be some massive risk event. We've already had several, right? We just finished, two significant risk unwinds with the carry trade. We're over it.
I mean, when I speak to investors, some of the pushback I get to this more optimistic view, one is that if we look at valuations of stocks and the expected earnings growth over the next 12 months is relatively high. And so many investors are saying that a lot of good earnings growth is priced in for the next 12 months. And it'll be hard for companies to deliver that unless they do job cuts or something bad, around that all. So what do you say to that?
Yeah, we would say go do global macro surprise number 2 in our 2024 outlook, which is better than expected productivity. Global surprise number 1 was lower inflation than expected, sooner than expected. That certainly played out. Surprise number 2 is better than expected productivity growth. And I would just highlight that over the last 12 months, according to the U.S. Labor Department, productivity growth in the U.S. is growing at 3.4% year over year, which is very, very meaningful. And productivity is the secret sauce, which allows companies to continue to generate earnings while global growth or U.S. growth is, settling in at, let's say, it's traditional or expected rate, right? I mean, the potential. Sorry, was looking for the word. Potential growth, which in the U.S. and in the developed world, we have to remember, potential growth, given that demographics are quite weak, right? Population growth is very low. And the way you grow is by 2 things, right? You expand the population or you improve productivity. And so potential growth in the U.S. and in Europe is, 2% or less. And so the fact that the U.S. is growing at 2.5% is above potential growth. And therefore, you have room for earnings. You have productivity growth, which provides room for earnings. And I agree, and we've made this point repeatedly, earnings are key. And as long as you see continued earnings growth and forward estimates continuing to rise, and we have a great chart in our monthly, just a shout out to the monthly, at 27 charts in this month's issue from 17 different sources. And one of them was the forward earnings estimates next 12 months in the U.S., in Europe, and in Asia are all in the U.S. and Europe double-digit. U.S. and Asia double-digit earnings growth expected over the next 12 months, and in Europe high single digits. And by the way, the U.S. forward earnings estimates have gone up meaningfully over the course of this year, suggesting that as analysts engage with companies and hear the latest view of companies and start to push out into the out year, which you and I are both experienced guys. We know that right now the focus is on 2025. It's not really on 2024. If you're an analyst, you're a strategist, you're an investor, you should really be thinking about 2025. And so the fact that analysts are raising their next 12-month earnings estimates after having had conversations with the companies in the Q2 results is constructive. And so when that is taking place, the idea that stocks are going to go down, I think, and go down meaningfully and stay down, I think is completely misplaced. And yes, valuations are somewhat extended, maybe perhaps in the US, and certainly, or I wouldn't even say with tech anymore. I mean, if you look at the Magnificent Seven, there was some good work done recently on this. PE to growth relative to the last 5 years, you're trading at like a 50% discount, 50% discount on a PE to growth basis today versus the last 5 years. And that's because the earnings power is off the charts, just literally off the charts. And people have a hard time wrapping their heads around, NVIDIA up 150% and thinking, well, it must be expensive. And the reality being it's cheaper than it was 12 months ago because earnings have gone up 200%.
But on the tech point, that's the other pushback I get from investors, which is that the US equity story is just a tech story. So as soon as the tech story fizzles out, or for some reason sort of goes down, then there's no equity story anymore.
Completely wrong. It's completely wrong. And it's not just my opinion, it's a fact. And the fact is that the equal weighted S&P just went out at a new all-time high yesterday. Yesterday. Okay. So, I mean, it's lazy thinking. It's just lazy analysis. It's completely wrong. The non-US or the non-tech part of the US is what's making the running. The fact, and this is an important point, okay? I don't mean to kind of be negative to others, but, the important point to us is that the US equity market has taken a significant hit to its leading segment and to the AI, lead dog, which is NVIDIA, and not suffered in any meaningful way. I mean, NVIDIA is still 20% or so off its 52-week high. Semis, if you look at SMH, which is the leadership, and the big driver in the AI space, and where we have significant exposure in our global model portfolio, SMH is 15% off its recent high, and yet the equal weighted S&P just went out at a new all-time high. How does that happen? Well, it happens because yesterday other things making new 52-week highs: the real estate sector, the industrial sector, the gold mining sector, European banks, for example, just went out at a new 52-week high yesterday, UFN. So the idea that it's just tech is just completely wrong.
And this reflects your core view that the global growth picture is looking relatively healthy. There's a productivity story. So the sort of the context is actually quite positive for equities, despite people talking in a more negative fashion. Now you did say in your monthly, you mentioned earlier, rotation is something you're thinking about. So when you say rotation, does that mean you were long or overweight tech earlier? Now you want to rotate to something else?
Well, we've been exposed, as I said, to technology for sure. We're big believers in the AI revolution. We're big believers that we're in the early innings. We believe that every country and every company is going to have an AI strategy, and it's pervasive and it's global, and therefore it's absolutely critical as an investor to have exposure to it. And the way that we have chosen to take exposure is in the pick and shovel context. So go back to the old, gold rush in California, right? It wasn't the gold miners who made the money. It was Levi Strauss who sold the miners their picks and their dungarees and their all that stuff. So we want to be in the semi space because no matter what happens with AI, semiconductor chips are required. And so we have a very significant position in SMH. It's a position we've held for, a year and a half or so, and we continue to hold it. We haven't sold any. We don't plan to sell any. And so that's how we're taking exposure there. But we do think there's opportunities in rotation from large cap to small cap. So we have a pretty good position in small caps, which are up 1.7% when I checked this morning, just before hopping on the call here with you. We are big believers in the rotation to cyclicals. I think there's a real big opportunity right now. I just looked at B of A's, fund manager survey, which is a great report this morning. And they point out that, the shift from cyclicals to defensives that have taken place over the last couple months is the biggest in 4 years. They point out that people are most underweight commodities in 7 years. And so we are overweight. Well, let me just finish on the cyclical. So we own industrials, we own financials, we own small caps in the U.S. We also think there's rotation from the U.S. to non-U.S. Because we think the dollar is going to sell off. We can get into that. But what I would like to talk about right now is the rotation to commodities. And so the fact that B of A's fund manager survey shows people are the most negative commodities in 7 years, and the fact, as we show on our monthly, that hedge funds are massively short commodities. The most short hedge funds have been in well over a decade on the commodity space, broadly speaking, is to us an opportunity. And it's an opportunity because we believe global macro surprise number 4 in our 2024 outlook was early cycle, not late. So we're believers that we are in an early cycle global economy underpinned by a global synchronized rate cutting cycle and a recovery in the manufacturing sector, which we believe is imminent, that we want to be overweight commodities. And so we are overweight and we have a massive, pretty massive overweight commodities and underweight fixed income, which, as I talk about in the monthly, has been painful the last couple of months because bonds have outperformed commodities. But, you know, one of the key lessons as an investor is to not take one mistake and double it. So we don't want to like sell commodities today and buy bonds, right? Because then we're just compounding our mistake. We believe, you know, given that our view is that there's nothing wrong with the global economy, we believe that commodities now represent a significant opportunity, very attractive risk reward. So we're long energy, we're long precious metals, GDX, we're long copper miners, we're long uranium miners. So, you know, we have a.
I mean, on the commodity side, you know, obviously there's a global growth component to that, but there's also a China component to that. And if you look at Chinese data this year, it's been relatively weak. Yeah, there's been various attempts by policymakers there to stimulate the economy, and it really hasn't done a huge amount. So are you concerned about the China story? I mean, does that affect your commodity view or not?
Well, you know, we we have a position in China too. I was talking with an old former Morgan Stanley colleague, Paul Jackson, who now runs global asset allocation at Invesco, and he just put out his quarterly asset allocation outlook, where he demonstrated an overweight in China equities. And I said, I got in touch with him. I said, we must be the only 2 guys left who are overweight China equity, because we're overweight China equity too, exposed via K-Web. So very much in the tech space. And we believe that that there's a 2 tech stack divide opportunity as the U.S. and China wall each other's tech stacks off one from the other, that China tech is very, very appealing and is, you know, sells it again, like a 50% discount. It's the cheapest it's been since 2008. I mean, we can go into all that in a minute if you're interested. But in regards to China and China growth and its impact on the commodity space, yes and no. You know, we take the view that China is going to grow somewhere close to 5%. We would make a note that that's more than double the U.S. growth rate. We would note that China is the 2nd largest economy in the world. And so the fact that the 2nd largest economy in the world is growing close to 5% year over year is a very, you know, is a pretty good outcome for the global economy. In terms of its impact on demand for commodities, it's true that China is a big source of demand for many commodities. It's also true that many commodities today, you have very low inventory rates. Inventory levels in oil are close to record lows. Inventory levels in copper are very, very low. Inventory levels in uranium are very, very low. And you have a very visible medium-term supply-demand imbalance with all 3 of those, or certainly at least with copper and with uranium. You can debate oil relative to, EV adoption and solar adoption and things of that nature. But, certainly with copper and with uranium, it's pretty clear that there's a looming supply demand imbalance out there that we think is going to manifest. And when people get off the recession call and get onto as we point out in the monthly, we're moving to a sustainable growth path. And a sustainable growth path for the global economy means what we have been calling our global macro blue sky outlook. In other words, we're quite constructive on the outlook for the global economy and for risk assets for the 2023 to 2027 period. So this is not a monthly, not a quarterly call, not even an annual call. This is a multi-year view that we are coming out of the last couple of years of all the concerns. People are finally going to have to give up on the recession call, going to have to embrace a global economy underpinned by rate cuts, by global liquidity, by a recovery in the global manufacturing sector, by a world that doesn't really have any major imbalances to it. And as people shift into that mindset, the fact that right now people are the most negative commodities they've been in 7 years, and hedge funds are the most short they've been in over a decade, that strikes us as a pretty good risk reward.
Yeah. And you mentioned energy. One of the themes you've been talking about over the years has been the whole climate change, renewables trade or investment thesis. What's your latest view on that?
It's been a very tough place to be, right? And there's just a stunning dichotomy between the massive adoption rates, right, particularly in solar, and massive expansion in the EV space, and the absolute catastrophic performance of the equities that are associated with that space. Right? I mean, it's just, if you look at LIT, which is the lithium miner and EV battery ETF, if you look at ICLN, which is the clean energy, solar, wind ETF, as proxies, even if you look at URNM as the proxy to uranium and nuclear power, I mean, these places have been decimated. And it's mostly decimated because, China, which has grabbed the global leadership role across pretty much the entire clean energy space, is, and is putting in place massive amounts of clean energy within their own energy grid, has too much capacity. And so that capacity is just driving down the profitability in the space, and obviously driving down, therefore, as we talked about earlier with earnings, driving down the stocks. And so we wrote in this month's climate piece, because we dedicate a whole section of each monthly to climate, because we think it's absolutely critical in terms of understanding where we're going from a global perspective. We talk about for the first time, there are some signs that this excess capacity is being reined in, right? I mean, we are seeing China's leading solar companies, for example, mothballing expansion plans. We are seeing China, the government itself, shutting off the IPO market for smaller solar companies and encouraging consolidation in the space. We see even CATL, which is the leading global battery maker, starting to talk about mothballing production runs for lithium. And so as we look at these things, we're starting to see the fact that companies are recognizing, and China's government is recognizing the fact that this excess capacity that's built up needs to be brought under control in order for people to be able to make money, and therefore to continue to roll it out. So, we have two model portfolios that we run at TPW Advisory. One is our global multi-asset. The other is our TPW 20, which is thematic, focused on basically 50-50 future tech and climate. And we've really taken down that climate piece. Like, to give you an illustration, that TPW 20 is probably more like 80-20, 80%, future innovation and 20% climate. at this point, just because we had to protect ourselves from the underperformance that's been so manifest. I'll give you an example. Lit, I just looked this morning, Lit LIT is down 25%, I think, year to date, versus, ACWI up 15%. And so obviously you have to, if you want to stay in business, you got to take that allocation down. Would we take it down? I think importantly, the question now is, would we take it down anymore? And the answer to that is no, based on what I just said about finally signs of, rational thinking and consolidation starting to manifest across the space. Okay. So solar, wind, battery, EV, et cetera. And then there's the whole discussion about, EVs and what that means for European automakers and all that type of stuff, which is a whole nother fascinating subject. Happy to get into it if you care.
Yeah. I mean, before we get onto that, I mean, we haven't actually talked about U.S. elections. Obviously, I hear there's U.S. elections. Nobody would know. So, again, it seems like a big one. With Trump versus Harris. How do you see? What would happen if either one wins? What does it mean for markets?
Well, we've had a very clear view on this. Again, we believe in clarity. We believe in facing reality, and we believe in letting people know what we think and where we stand. And so we've had a view that first Biden and now Harris was going to win in a landslide. That was in print at the beginning of the year. We stepped off that landslide view after the first debate when President Biden clearly demonstrated some real concerns about his capacity going forward. And we reinstated the landslide a couple weeks after President Biden decided not to run, and Kamala Harris was kind of universally acclaimed as the Democratic nominee. And basically the thinking is that, besides the fact that Trump is an insurrectionist and should really not even be running, the fact that he's a convicted felon, an educated rapist, and arguably a domestic terrorist, he has no capacity to get beyond 47% of the vote. He's never gotten more than 47% of the vote in any of the elections.
Just on the polling, you mentioned the January 6th insurrection and his criminal charges. They haven't seemed to have dented his polling. You would have thought that, January 6th or the convictions, over the course of this year, his polling would have cratered, but it didn't, So I kind of wonder if those are factors in how the public are seeing Trump or not.
Yeah, I think it gets to my point I was just making, that he has a rock solid base, to your point.
Okay.
100%. Not arguing that. My point is that he has no capacity to expand the base. Mm-hmm. And in fact, he has had to continue to double down on more divisive, more just vile rhetoric in order to satisfy the base. And that strategy came undone and completely imploded with the debate with Kamala Harris, where he was like a lunatic ranting and raving on 34th Street in Manhattan, talking about eating pets and killing babies. So, anybody who watched that debate and thinks that is the guy who should be president of the United States needs to have their head examined. Full stop. And so I believe that we have witnessed probably the most consequential series of presidential debates in the history of the United States, where in the first debate, one of the favored candidates was knocked out of his chance for a second term, that is President Biden. And in the second debate, the other favored candidate, former President Trump, was knocked out of his chance for a second term. And so, yes, we have to wait till November 5th to find out if that's a fact. But I am in print and, feel very strongly.
I'm impressed by your confidence levels here, because when you look at polling or these prediction markets, Predicted or Polymarket, they're all kind of 50-50, 51-49.
No, I mean, I think that's just wrong. Sorry. There's very clear that Vice President Harris is now polling, when you look at the average of polls that are credible, somewhere between 5 and 6 points ahead of former President Trump. And I think, again, she's going to win in a landslide, certainly in terms of the popular vote. The Electoral College is another question, but I would make a couple additional points. One, Vice President Harris is leading in all facets: fundraising, engagement, volunteers. One of the charts we put in the monthly was, Democrats versus Republicans enthusiasm to vote. How enthusiastic are you to vote versus prior periods? The Democrat number is the highest it's been since 2008, somewhere around like 65, 68%, significantly higher than the Republican number. And so when you look at kind of across the board, the other point I would make is that abortion is on the ballot in many of the key swing states. So this is an important consideration to deal with the Electoral College question. Abortion is on the ballot in multiple swing states, and that is for sure going to drive out Democratic voters. And so when I think you put it all together, when you think about Trump's inability to penetrate beyond his base, and everything he's been doing since then has been basically reducing any independents' likelihood to vote for him, not increasing it. When you look at the enthusiasm gap, the fundraising gap, the volunteer gap, the field office, just as an illustration, Vice President Harris has 1,500 field offices across the United States. Former President Trump has 300. 1,500.
Oh, wow. Okay, that's quite a dramatic difference there.
Yes, exactly, fivefold. And these are the things that we do at TPW Advisory, right? We gather facts, and we are focused on facts of fundraising, facts of voter offices, facts of abortion being on the ballot, facts that former President Trump has not been able to ever poll above 47% in any kind of election. These are facts. This is not just Jay Pelosky making, his opinion. These are facts. And so those facts, though, allow us to take a point of view. And then let's just finish up on the policy mix, because I think this is also really important for investors. Multiple independent groups have looked at the two policy mixes such as they are. Let's just focus on economic policy. We won't focus on the, former president's intent to jail his political opponents or engage in the most aggressive deportation program in the history of the country, which he would said would be bloody. Okay, we're not even going to talk about that. Let's just talk about the economic policy mix. And the economic policy mix has been looked at and reviewed by Goldman Sachs, by Moody's, by the Peterson Institute, by multiple players, and every one of them said very clearly that Vice President Harris's program is much better for the U.S. economy than former President Trump's. You deport 10 million people, what happens to your labor market? I mean, you increase tariffs 60%, 100% on every country. What happens to your inflation rate? I mean, it's just like, when you give tax cuts, more tax cuts, what happens to your deficit? I mean,
one thing equity investors are saying is that Trump cutting corporate tax rates, that will help US earnings, and so that will be positive for stocks. So that is one thing people are holding on to for, Trump. Because when you look at the way investors or analysts look at, Trump win, they often say Trump/Republican win is good for equities, tax cuts, and then, Democrats won't be so favorable to corporates.
Yeah, and I think that's probably true, that President Trump would try to cut the corporate tax rate a little bit. I mean, he would need Congress's support to do that. Similarly, Vice President Harris, were she to become president, would look to raise corporate taxes again. A lot of people talk out of both sides of their mouths, right? A lot of people say, oh, under President Biden, the deficit's 6% of GDP. And then they say, oh, by the way, former President Trump will cut taxes and raise the deficit to 8% of GDP. But that's fine because corporate earnings will be better. Okay. Can't have it both ways, people. Sorry. And so, Congress is going to be important. And one of the things that I think is likely to happen, where again, very, very few people agree with this, is the likelihood of a Democratic sweep. And I would just point out that people are pretty much giving up on the idea that the Republicans will hold the House, but they still view, given that there are many more Democratic Senate seats in play, that the Republicans will hold the Senate. I would just point out that, again, well, these are polls, but so much are facts, but, virtually in every swing state, Democratic senatorial candidates are polling well ahead of their Republican counterparts. And one of the things that the Harris campaign is doing with their much greater funds on hand is they're funneling money down ballot. So they are allocating, I think I saw $25 million recently to down ballot races so that when Vice President Harris becomes president, she will be able to operate with a Democratic Senate and a Democratic House. And to us at TPW Advisory, this is really important, and we can finish here maybe on this topic. Policy continuity is key for the U.S. to continue its growth path. The idea, the reality is that under President Biden, the decision to go big post-COVID and to really push the public-private funding partnership that's visible in the CHIPS Act, the Infrastructure Act, the Inflation Reduction Act. These things have allowed the U.S. to have by far the best growth profile of any developed economy post-COVID, by far. And so we want to sustain that, I would think. And so the idea of a continuity in policy between President Biden and Vice President Harris to become President Harris and sustain that policy mix is absolutely critical to our global macro blue sky outlook. And if we wanted confirmation of that, we could just look at Mario Draghi's report on how Europe can restore its competitiveness, which is basically do what the U.S. has been doing.
Yeah, copy the U.S. That's true. Now, you talk a lot about, and your organization's Tripolar World. So can you just remind us what you mean by Tripolar World, and where are we on that right now, given all the geopolitics that we see?
Yeah, thank you for asking, because it's something that is obviously core to our thinking. It's in our name. TPW Advisory stands for Tripolar World. And it's actually a thesis of mine, frankly, that I first started to develop and write about after the great financial crisis, when it became really apparent that there was no kind of policy focus other than monetary, right? It was all left up to the central banks to get us out of the great financial crisis. And it was clear to me, as a guy who benefited from this, the whole Washington consensus, capital going to EM and all the rest of it was dead, right? And it was dead because finance was the tip of the spear of that whole policy mix, and finance retrenched dramatically, obviously, post the great financial crisis. And so my thinking, as I articulated, starting now back in 2010, I think was the first time I published anything with the word Tripolar World in it, was that we are shifting away from full-on globalization. We're not going to go back to nationalism because it doesn't work. I mean, you're in the UK. How's Brexit working out? And instead, we're going to regional integration in the three main regions of Asia, Europe, and the Americas. And pretty much everything, and that's because each region has its growing ability to self-finance. Just look at the development of Chinese financial markets. Self-produce. Look at how production has moved around last 10 or 15 years, and self-consume. As regions grow wealthier, the ability to consume expands. Again, look at China, look at parts of Latin America, look at the periphery in Europe, et cetera. And so that was really the initial impetus. Now, fast forward to today, and over the last couple of years, and we would argue that what we called several years ago the 3 C's of COVID, climate, and conflict likewise require regional integration, regional structure to compete, because no country really has the wherewithal to compete in all those areas. Again, COVID made that very, very clear, right? Everybody all of a sudden worried about, oh, we don't produce this and we don't produce that, and where do we get it? And then climate, right? You can do what you're doing over there in climate, but if your neighbor's not doing anything, you're in trouble. And then conflict, the Russian invasion of the Ukraine, what's going on in the Middle East, worries about Asia. So all those things are driving regional deepening and regional integration. So you think about nearshoring, you think about friendshoring, you think about recasting of supply chains. You look at the CHIPS Act, right? Everybody wants to have semiconductor production in their own region. Okay, that same is happening in Europe. We need to have semiconductor production. Look at climate. Everybody wants to have a battery supply chain in their region, say in the United States and in Europe and in Asia. And then you look at AI. Everybody needs AI, as I said earlier. Every single country, there's something called sovereign AI, okay? Every country wants to make sure its AI models are not corrupted or available to others. And so you're seeing and again, it's too expensive for any one country to do it all. So you're seeing more regional integration in the AI space. And now, even just in the last week or two, who's going to fund the Middle East? Who's going to be able to provide cutting edge semis to Saudi Arabia, to the UAE, et cetera? How can we really trust them with the absolute cutting edge of semis? You look at what's going on in China. China has to manufacture and develop all this itself because we're cutting them out of it. And look what happens in return. Apple is no longer the leading smartphone seller in China. It's number 5. Look at Tesla in China. Tesla is no longer driving the EV revolution in China. Its sales are barely top 5 in China. So Huawei is not in the U.S. stack. And guess what? U.S. companies are increasingly not in the China stack. So it is AI and tech is really driving the regional integration. That's why, as I said before, we see a real opportunity in the fact that there are multiple tech stacks being created around the world. And particularly, we focus on the U.S. versus China. The expensive nature of U.S. tech, as you and I discussed, a few minutes ago, and the extremely cheap nature of China tech, and particularly when we think about the fact that China tech, the e-commerce market is double or not triple the size of the U.S. e-commerce market, and it's growing at twice as fast. Yet the companies that dominate it trade at a 60 to 70% discount versus the U.S. peers. That is an opportunity. Now, when it actually gets realized is a fair question. But, right now, the risk reward of owning KWeb, we think is really very compelling.
That's fantastic. Now, I just wanted to round off the investment view. So, so far you've given this positive outlook on equities, overweight commodities, underweight rates, and you said you were bearish on the dollar. So I just wanted to round off with that, just to make sure our listeners are fully cognizant of your view. So you have this bearish view on the dollar. Could you just outline why you think the dollar is going to go down?
Yeah, absolutely, and it's a key point. So thank you for bringing it up and reminding me. But yes, we've been dollar bearish for quite some time, and that has again not worked. Right, so part of being successful, particularly in the global macro space, is having a process. And we talked about that. We actually wrote one of our musings. We write every Friday, our Friday musings. was stick to the process, right? Because with all the dip and rip markets that we've seen in the last month or two, if you just stuck to your process and rode through that, you'd be perfectly fine, right? And trying to trade with and against the machines is absolutely a losing strategy. And we have to realize that today, the vast majority of day-to-day trading is machine and algorithmic driven. It's not humans making decisions. And that's why you see things go right to technical levels, right? And so you have to pay attention to technical levels, because the machines are programmed to run to those certain points. And that's why you see things moving much, much faster than they did even a couple of years ago, because it's all one-sided. It's all machine going one way, machines going the other way. And we've learned as basic investors over the last 10 years or so, you can't fight the machines, because they are, they're too disciplined and they have too much money behind them. And so people don't fight the machines anymore. There's really not that, hedge fund taking the other side of the trade type mentality that you and I grew up with 15, 20 years ago. Doesn't exist. So one of those trades is the dollar. And our view has been that the dollar was going to weaken because the gap between US rates and the rest of the world was going to narrow, and the growth rates between the US and the rest of the world was going to narrow. We pointed out earlier that the US has been by far the best performing developed economy post-COVID. And we think that outperformance is going to shrink. And that really has, not happened as much as we thought it would. In part, you look at Europe, right? Europe's growth profile. I mean, Germany, we could have a whole discussion on the woes of Germany. But clearly Europe has not recovered as quickly as we might have thought. And therefore that performance gap hasn't shrunk, and therefore the dollar hasn't really weakened as much as we thought it might. It has weakened. Technically now it's broken well under its 200-day moving average. It's very expensive. It's very overowned, right? I mean, the U.S. has been by far the best performing asset in the world since the lows in 2009. Foreign investors are massively overweight U.S. equities. Foreign investors own a lot of bonds, a lot of corporate credit. And therefore the dollar, my good buddy and former head of global FX strategy at Morgan Stanley, Stephen Jen, believes that fair value for dollar yen is at 90. Believes fair value for euro dollars at 1.25. So, you look at the emerging markets, you look at Brazil, the real at 550. You look at the Mexican peso at 20. The dollar's expensive. So it's overowned, it's expensive, it's breaking down technically, and the fundamental underpinnings we believe are shifting. And by the way, DXY, right now it's at 100, give or take. If it breaks 100, it's a pretty quick drop to 95. We think that's quite likely as the Fed engages on a rate cutting cycle and starts to catch up with the rest of the world. And we think that dollar weakness then supports our non-US equity positions, supports our emerging market local currency debt positions, which we have a pretty good amount of. And that's where we really felt the dollar not weakening, is in EMLC, which is the ETF for local currency debt, where we have a pretty big position, and we continue to hold it, and we're not going to sell any of it. And also in commodities. So we see the dollar as, again, kind of a tailwind to a weak dollar as a tailwind to our non-US equity and commodity positions.
Yeah, that's great. Very comprehensive sort of take there. Now, I just wanted to round off with a non-markets question. I like to get some tips on what to watch or read or anything like that, movies. Have you consumed anything culturally that you'd recommend to me?
Well, yeah, you may not be interested, but I'm a big American football fan. I played American football in college, and am actively involved. I'm not sure if you're familiar at all with the term NIL in regards to college sports in the United States. Well, it says that NIL stands for name, image, and likeness. and basically means that college student athletes can now get paid for their name, image, and likeness. And this is a new concept, only a couple of years old, and it's led to a whole kind of. There are many things going on in college sports in the United States, and college sports, particularly football and basketball, are huge money-making machines. Basically, because the only thing that people watch on any kind of schedule on live TV is sports, and particularly football. By far, the top 50 shows in the U.S. Are either pro or college football games, and so the networks, as they compete for the contracts to show these games, are paying ever more amounts of money to colleges. And these colleges now are being pressured by athletes and others to pay a share of that money to the athletes, to the student athletes. And so there's in the U.S. fashion, there are very few guardrails to this process. The only guardrail is that the universities cannot provide the money to the student athletes. That needs to be done by a third party, which have become known as collectives. These collectives are groups of supporters that come together to encourage other supporters to put money behind this name, image, and likeness process, and that collective then pays the student athlete. So I am a founding board member of the collective that is in process for the school that I went to, which is Duke University. And Duke is a big basketball school and a fairly big football school, trying to get bigger in football, because what really drives college athletics is football, not basketball. Football, the TV money for football is much, much bigger. And so, when you ask if I consumed any, cultural stuff, I mean, I do have my bookcase behind me, and I was at one time a big time reader. I read so much now for work that I read less for pleasure these days. But I have watched a lot of college football over the last couple of weeks.
The whole NIL thing is fascinating, and it seems like it's a whole new industry that's that's emerged around college athletes.
It's fascinating. It really is, because it's moving at warp speed, and there's two other factors which I'll tell you about quickly to round out the picture. So NIL came into vogue, and basically it was through the courts, right? The kids were suing the NCAA, which is the regulatory body for college athletics in the U.S., saying that they were basically, not being allowed to get paid for their labor. That's simple. So at the same time, the NCAA also was sued because it was not allowing kids to transfer from one school to another without certain penalties. Namely, you have to sit out a year, right? So if you're going to a 4-year college and you're a highly talented basketball player, and yet you're not playing because you and the coach don't get along, you want to transfer, they would make you sit out a year. Okay, that was struck down in the courts. So now you can transfer and play, in the same year. So NIL money plus ability to transfer plus a real focus on conference realignment, because the TV networks that are driving all of this, they want to have bigger conferences so they have bigger footprints and more people watch their games, right? So you had conferences which have been in existence in the US for 50, 60, 80 years are breaking up as schools go from one to the other, because the conference with the bigger TV package can pay the schools more money. Okay. And these are sizable amounts of money. To give you an illustration, the SEC, which is the Southeastern Conference and is the premier conference for U.S. college football, pays each school $80 million a year for the TV rights to watch football and basketball. That's a lot of money. And so as a result, if you are not performing in football and your conference is undergoing realignment and you are not part of the realignment, all of a sudden your school has to make up the 80 million bucks, right? If you get dropped from the SEC, all of a sudden your TV money goes from 80 million to zero. And obviously zero is a problem because, you have, 20 plus sports that you are funding as a typical college, Division I college in the United States. So football pays for, lacrosse, for tennis, for swimming, for diving, for softball, for women's basketball, for women's lacrosse, for women's soccer. All those things are paid for by these TV contracts. And so all of that being said is that there's multiple new things happening, which are creating upheaval and really forcing people to understand what, you need to do to be successful. And so basically what you need to do to be successful is you need to be able to raise the money to pay the NIL to players that you have evaluated correctly insofar as their talent and their ability to contribute to your team. And it's really like a pro style. So the college coaching staffs are expanding and becoming much more like a pro NFL style back office in terms of the amount of people responsible for talent identification, because you're not just recruiting kids out of high school anymore. You now have to recruit the portal. And you're not just looking to replace, players you've lost with graduation. You're also trying to keep your top players from going to somebody else's school as they offer your kid more money. And so it's just, it's
just, I mean, this may be a silly question, but in Europe, we don't really have this concept of professional leagues and then college leagues. Like with soccer, there's just the professional soccer leagues, and that's what people watch. No one watches college soccer in Europe. I mean, why do people watch college football in the US when you have the pros who presumably are much better and it's more, why is there this college? Why is there this popularity of college football?
Yeah, it's a great question. And actually been thinking about it because people are talking about, I mentioned the Southeastern Conference being the premier college football conference. And part of the reason is because those schools are willing to commit the resources to make sure that their teams stay on top. And those resources are being committed by donors who have an allegiance to those schools because in large part, they typically have not had professional franchises. Okay, so that's where your question really fits in, right? A lot of parts of the United States do not have professional franchises, or until recently, certainly did not have. And so you have in Georgia and Alabama and South Carolina, in Florida, you have these schools that have grown up and the fan base for college sports is rabid, right? Where these guys are selling out, at Tennessee, it's 105,000 person stadium.
Wow.
Okay. And it's sold out. Okay. University of Michigan, 105,000, Tennessee, Texas A&M, 103,000 stadium capacity. And they sell out, all their games. And so a lot of it stems from, the affiliation that you have. Like for Duke, as an example, Duke basketball has been a dominant program for decades. And anybody who goes to Duke is super excited to go to Cameron Indoor Stadium and watch a basketball game and be part of that. And that experience, ties alumni together going back decades. And that is, when you look at a Duke, if you were to go online and, you said you had a kid about to go to college and you say, hey, maybe Duke would be a great place. Jay said it was great. Let me check it out. You will see very upfront in the marketing, Duke basketball, because it separates Duke from the Ivies. Because Duke is right there academically, but it's way above the Ivies in terms of athletics and that camaraderie and that excitement and all that stuff that it brings to the table. And so it's a critical part of the Duke experience. And it's one of the things that we at the collective at Duke argue and discuss with the administration, the importance of supporting football, because if they don't support football and the conference that they're in, which is the ACC Atlantic Coast Conference, decides that Duke should not be part of the conference going forward, then one of the key pillars that differentiates Duke versus the Ivies goes away. So it's not even just an athletics issue. It's an arguably existential issue for the university as a whole and should be thought about in that way. I wouldn't say we've made 100% agreement on that yet with the people at the
but you're getting there.
But we continue to argue it, and I think it's gradually becoming more accepted. But it is a fact. You look at any Duke marketing, basketball and sports and athletics is upfront because it completely differentiates Duke versus its peer group competitors, which are the Ivy League schools, which don't give out college scholarships for athletics and therefore do not have the same emphasis on sports.
Okay, that's great. Well, as well as learning a lot about markets, I've learned so much about US sports as well now, which I really appreciate.
Yeah, hopefully that was, I'm not sure it was the cultural.
No, it's great. I've learned a lot. So it's great to hear that. Now, before we finish, I just wanted to ask you, what's the best way for people to follow you, to sign up and so on? Sure,
I appreciate that as well. So TPW Advisory, you can go to our website, at jpelosky.com and find us and sign up there. There's an opportunity to sign up for our musings in our monthly. We also provide, as I mentioned, model portfolio delivery service for our two model portfolios, global multi-asset and TPW 20 thematic model. Those simply reach out. Again, it's available on the website to reach out, and we will be in touch with you if you have interest in the model portfolio delivery service. We do not manage money. We provide the models for a fee. We update the models once a month, and we have a very well-established process where we write our musings every Friday for 3 Fridays a month. Then we do our monthly, which is a deep dive, typically 4,500 words, 25, 30 charts and tables. And then the following week, which is this week, tomorrow, we will do our monthly model portfolio update, in which case clients get new models, they get an explanation of what the changes are, and we engage in a one-on-one conversation with me every month to discuss those changes. So that's kind of what we do. We've been doing it for a bunch of years. We're excited about the markets. We continue to love what we do, and we have a point of view, and we are independent. And so we really drive the independent part of the process. I was head of global asset allocation at Morgan Stanley. I know very well the challenge of integrating multiple smart people's views into a firm view. We have an independent view, which we think often is differentiated from the big investment banks. And the last point I would say is that my own personal capital, the vast bulk of my investable capital, is invested alongside our clients in that global multi-asset model.
No, that's fantastic. And I'll include links to everything in our show notes. So with that, Jay, fantastic to speak to you, and good luck with everything going forward.
Thank you, Bilal. Thanks for having me. Great to see you again, and good luck with everything in Macro Hive.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.